Good afternoon, everybody. Thank you so much for joining us. My name is Michael Del Castillo, Senior Editor at Forbes, where I help oversee our blockchain and cryptocurrency coverage. Today with the inimitable Joshua Ashley Klayman, lawyer at Linklaters and widely known as the mother of blockchains. Josh, thank you so much for joining us today.
Thanks for having me, Michael.
One of the things I love most about this show, I think a lot of our viewers are starting to understand this, is our chance to kind of go back in time a little bit before our guests were known for why they got invited on the stage. We're going to go back in time a little bit and briefly get to know you and kind of like how you got to this position. So let's go literally to the beginning.
Okay.
Where were you born? And tell us just a tiny little bit about mom and dad.
Okay, so I was born in Bloomington, Indiana.
All right.
My parents were about 25 years apart in age. My mom was a Playboy bunny.
All right.
And my dad had meatpacking companies.
Okay.
Which he tried to stop doing, but he never seemed to be able to stop doing.
It was in his blood.
Yeah, it was a family business. Yeah, so yeah, my parents, they divorced when I was very young, or at least they split when I was very young. So I grew up with my mom, and we moved around a lot. So I went to about 11 different schools. And yeah, but they were both from Philadelphia. So they actually both ended up back in Philadelphia. And later in life, they were very good friends.
And your mom had a little bit of a education that we have to call out here, right? So how did she get from Playboy bunny to her education career?
So it's funny. She started going to college after she had me in Bloomington, right, at IU. But then she stopped. And then she didn't resume that until I was in middle school. And so she went back. And at that point, she was a single mom with 3 kids. And she finished that. Then she ended up getting master's and then another master's. She started going to law school, but then my grandmother got sick. And so she left to go take care of my grandmother, who passed away, sadly. And then later, my mom got a PhD.
A PhD in?
Education.
Very cool. So when you look back at those years, Playboy mother, PhD in education, meatpacking maven father, when you think about your young Josh growing up, what's the first evidence that she was going to grow up to become one of the world's leading blockchain lawyers?
Wow, that was probably pretty late.
Okay. All right. So then we'll jump ahead a little bit.
I guess if you would have seen me back then, I was very kind of bookish, nerdy.
Okay. I like that.
When I was little, I loved books. I was extremely, extremely shy. And I liked just to be outside and with animals and reading and stuff like that. Because my mom was a single mom and there was some strife with my dad, we grew up actually very, we didn't have a lot of stuff. So I had free lunch and stuff for most of the time. But I loved disappearing into books. And that carried through, just to skip ahead. So when I was in college, I ended up starting my family actually in college. So I had my first child when I was in college at Penn. And one of the things, though, that I loved doing was going to the bookstore in my spare time, right, as I was working and stuff, and reading about game theory.
Yes.
So I would say, even though I didn't know later about blockchain, or it didn't even exist yet, this was the last millennium, because I graduated in '99 from college, that was something that got reignited later, was this love of game theory and just thinking about, motivations.
So I love this connection between game theory and kind of you're slow, maybe quickly falling in love with blockchain after you discovered it. For people that don't understand how game theory could somehow trigger a career change into blockchain specifically, give us just one little example here, an early game theory love that kind of came back to you as you were discovering what blockchain and maybe specifically smart contracts has in store for us.
Sure. So if I think back to when I first encountered blockchain, at that point, it wasn't immediate love, because at that point, I was a finance lawyer and I was trying to figure out, oh my God, am I going to be supplanted by this technology? Are my loan agreements going to be written by smart contracts?
Smart contracts, self-executing code
Yes.
that has inputs and outputs,
Yeah.
and that seemed to maybe automate a lot of what lawyers do.
Exactly.
Yeah.
So that was, and I was hearing about it from big banks who were saying they were going to reduce legal spend. So I kind of went into it with a skeptical eye, like, what is this? How do I make sure I'm not obsolete? Right. But then I ended up meeting a number of people very early, some of whom are now, they pretty much were big names back then, but they're even bigger names now. And one of the first experiences I had was actually, although let me just say, I don't represent them now, and nothing I'm going to say is legal advice,
Gotta get that in
investment
there.
advice, any kind of advice. This is not stuff from my firm. This is my personal musings. But one of the first people who I got really excited when I was talking with him was actually Jay Kwan of Cosmos. And at the time, Cosmos didn't exist yet, really. It was Tendermint.
Tendermint, I remember
right?
them, yeah.
And All in Bits. And yeah, I just remember him talking with me and describing, all of these visions for what later would become Cosmos. And I was like, oh my gosh, wait a minute. Like, just everything, like the Byzantine general, all these sorts of things. I was like, wow. And even if you think about mining, right, holding aside that, right, if you think about mining and the fact that the idea, how do you know somebody's not going to collude? Well, because it's not in their best interest, right? They're going to hopefully continue doing that in an ethical way, because the minute that they do something wrong, that they validate the wrong, that they compromise the system, then it's valueless. Yeah. And so I think we see that in everything, even when we look at staking now with different blockchains, for example, with Polkadot,
Yep.
right? And you think about what incentivizes people to stake or not, right? The way the design is built in to incentivize you to actually participate in the ecosystem. It's really, I just find it all fascinating.
I love it. And so you started off as a finance lawyer, maybe fintech specifically. I'm not sure if we can go that far.
No,
generally,
just like doing leverage buyouts.
Leverage buyouts. I love it. Okay.
Securities law. Like it was. I was definitely just. I thought bankers were my tribe. I thought I had left all that other stuff behind. And I've said this somewhere else once, but I was very interested in college in the Santa Fe Institute. Yeah. Right. And I wished that I could have run away and joined it. Right. And studied complexity theory and, all sorts of theories.
Nuclear power.
Chaos, like all sorts of things. And I just thought it was all behind me, that I chose a road that would be financially rewarding, and secure for my family. And then lo and behold, it was the biggest surprise that I found something that I felt so passionate about, and I still do.
Very cool. And so you did pivot, became one of the first full-time blockchain and cryptocurrency lawyers. Roughly what year would you say you officially became a full-time blockchain lawyer? Well,
I know that I would say 2015.
2015,
right?
yeah, that's about what I would guess as well. So since 2015, for roughly 8 years, you've been a full-time blockchain and cryptocurrency lawyer. And we could, I'm sure, talk about dozens of cases, or maybe not, and all of your iterations. You've been around. I was thinking about this actually preparing for our conversation. I feel like in the past, some law firms have courted you as sort of a way to show they were serious about blockchain and crypto. It's almost like hiring Josh is the first step towards showing the world that you're serious about this industry.
Thank you, Michael.
And you are currently at Linklaters.
Yes.
What's your formal position there? And tell us a little bit about sort of the kind of clients you represent, what your day-to-day looks like.
Sure. So my title is U.S. Head of FinTech and Head of Blockchain and Digital Assets, and I'm also one of our global tech sector co-heads. So what does that mean for our clients? It really runs the gamut. So everything from layer ones and I would say layer zero.
Yep. Layer ones meaning the foundational layer of a blockchain with a native crypto asset, and layer zeros meaning blockchains that connect other blockchains.
Yes, exactly.
Okay, cool.
Thanks. Yeah, so I represent those. I represent companies that have wallets, right? Some of these are public companies. I represent e-tailers that are looking into the space that may be public. I represent banks that are considering everything from custody to, some of them are still considering how to define digital assets and what their investment strategy might be. Also certain funds. I mean, it really,
Okay.
video games companies, it really, everyone who touches digital assets, I would say.
So e-tailers kind of surprises me, honestly. To be clear, we're talking about online retailers where you can go and buy stuff. One of the big, most popular strikes against crypto is that you can't buy anything with it. There were, in fact, some early markets. OpenBazaar jumps out to me, which incidentally is making a bit of a comeback. That's another story, though. But there does seem to be this big gaping hole in the crypto economy, which is it's difficult to buy things with it because there aren't a lot of people selling. That definitely has made it look more like an investable asset than a money. And those institutions that have tried to open up to make something where you could buy goods and services with crypto haven't really done that well. It does kind of feel like that might be changing a little bit. With e-tailers on that list, are we maybe seeing some new activity in that space, or is this more 10, 15 years down the road?
So I don't know if it's necessarily always going to be that they're purchasing with digital assets.
Okay.
But rather potentially offering digital collectibles. I hesitate to use the word NFT.
Okay. It's
NFTs,
become a hot word.
Yeah. I mean, because I think sometimes some video game companies aren't such a big fan of, and others, different types of audiences
I
don't
love
necessarily
that
like
Reddit
NFTs.
did really, really well with its NFTs by not calling them
Yes,
NFTs.
exactly. And so, it's hard to know exactly what to call them. But I do think just both for brand expansion, and we're starting to see the IP law develop along with that, with, for example, the Meta Birkin case, and then these cases that are unfolding where people actually even going into like AI, where they have the, I think, Getty Images has a lawsuit, and then those individual artists have lawsuits talking about how you're training the AI. So that's all being shaped ownership. But I think alongside, in addition to the brand expansions, then you have, and I know this is another buzzword that people aren't so crazy about, but metaverse.
Yes.
Right? And, some people believe we're going to be all wearing headgear to get in there. I don't think so. And so I think more likely we're going to be playing our way in, with video games, or just zooming our way in, the ways that we've gotten comfortable entering.
So that kind of begs the question. We hadn't really planned on going down this route, but I'd love if we could kind of put a little bow on that idea.
Sure.
Based on your conversations with your clients, your research, just your general knowledge of the area, like what will retail stores look like in the future enabled by blockchain? Possibly accepting crypto, maybe not, I'm not sure. But how will retail stores look different in 5 or 10 years than they do today?
I mean, I think we're already starting to see the transition where you have, and actually in some ways, I think if you look at video games and how there's been buying and selling of skins for a very long time, my good friend Angie Dalton could talk about this like forever. But yeah, I think we're starting to see that migration. So we've seen partnerships between brands and video games, right? For example, if we think of Burberry and the shark, right? Which sold out like very, very quickly at a pretty high price point, and I think we'll see more of that. I think what's really going to be interesting too is in the past, a lot of times luxury brands, they didn't want secondary markets to exist, right? Because they were kind of separated from them. I think we're going to see more and more that they're facilitating them, right? And potentially using tracking technology, which blockchain,
we're definitely seeing that trend on our annual Blockchain 50 list of retail and producers, even not just sellers, but producers really getting into the idea of being able to see either physical or digital versions of their goods traded on secondary markets. It'll be fun to see.
Yeah,
you talked about them. Go ahead. Sorry.
I was just going to say one other thing, which is, I used to be a bit skeptical, like, who's going to buy this, right?
Yeah.
But once we got into the pandemic and I started seeing colleagues and others having all these fancy backgrounds for their Zooms, the presidential desk or something like that. And also when we start looking even on Instagram and other things on the internet, people don't even look like themselves. You know, we're becoming avatars.
Yeah.
So like not only do you like put on the face that you want and the hair that you want, you put on the outfit that you want. And, you know, brands want to be part of that.
We might build little bits of the metaverse on our own through the technology that we adopt and put into old-fashioned technology like Zoom.
Yeah, exactly.
Fascinating. You talked about sort of how some of the maturity of intellectual property law is changing. You've been writing pretty prolifically about other legal law changes in crypto specifically, and kind of like how people have been begging for some clarity for a long time. And maybe not getting that, maybe getting that. There's some nuance there that I think is really important. Now, let's start off with the problem. So what have people been begging lawmakers and regulators for years from the crypto side, and where are we today?
Well, Michael, you named it. I mean, clarity. That's like the buzzword. And I feel like when people initially asked for it, it was an actual ask. And now I just think when people hear our industry asking for that, from outside of the industry, it sounds completely disingenuous. And frankly, sometimes from sitting in our industry, it sounds completely disingenuous.
Yeah.
I mean, there are some things we don't know, right? But there are some things we do know, which is, for example, if you're capital raising using a token, we know how the SEC wants you to treat that. We know that they think that that is likely highly likely to be the sale of a security. And we know how to sell securities.
Yeah.
So just things like that. I mean, I could go on.
So
and
let's briefly just go back. So
Sure.
2015, you were just getting started as a full-time blockchain lawyer. People were earnestly asking for this regulatory clarity. They thought maybe there was a new thing here. Maybe it wasn't just a commodity. Maybe it wasn't just a security. Maybe it was neither. Maybe it was both. And they were very publicly asking for clarity, some guidance from regulators on how this should be interpreted. You think that we've gotten that over the last couple of years?
I mean, I don't see how it can get any clearer, at least from the first step.
Yeah.
You know, it's later things like, okay, well, what do we do with tokens if they were illegally issued securities? You know, even if the platforms register as an ATS or National Securities Exchange, who's going to be able to trade those, if anyone, in the US, those existing tokens? But I think, I mean, even if you go back, I don't remember if it was 2016 or when, but it predated the Dow report by a while. If you think back to Lee Schneider, when he used to be at Debevoise, right? And there was that memo that talks about that the Howey test might apply.
Yeah.
This was pre the Dow report.
The Howey test being the way that the SEC determines if something is a security.
Right.
Yeah,
An investment contract, which is like one type. But you could have other types of securities where something looks like a note or a stock or something. But yeah, the whole idea of the investment contract, and just because I mentioned, I'll just say an investment of money in a common enterprise with a reasonable expectation of profit based solely or primarily on the managerial or entrepreneurial efforts of others. Okay, now I'll never say it again.
and to put that really simply, if I give somebody else money and I hope that I'm going to make money off of their work, that's almost always a security. There's some nuance there, but for our audience that isn't going to like get into those details.
Yes. Yes. I mean, and I think this is the thing. Part of the question that existed at the beginning, I mean, yes, securities lawyers, you could look at things and be like, okay, this looks like it could be a security. You have to remember, like, it was a very different time. And VCs weren't really involved in this space in large amounts. Yeah. Right? So the idea was that you didn't have to go up and down Sand Hill Road, right, to get an investment. You could have everyone participate, and you could democratize any sort of, not just participation, but returns, right? And so it was supposed to be something different. It was supposed to be something hopeful. And so, you know, people did their best. They went out. Many of them went to Switzerland. They thought that, okay, I'll do this foundation because, you know, they were trying to be compliant with law. They just weren't
just not this law.
Yeah, they just didn't know. Like, people, I mean, and I think some relied, say, on Swiss counsel, who might not have realized that U.S. law applies if you're dealing with U.S. people. Yeah. But I think we're so far past that. Yeah. I mean, even when the Dow report came out, I remember saying, okay.
The Dow report, really quick. This was 2017?
Yes, July of 2017.
And very quickly, what was it?
Sure. It was the SEC's first real line in the sand. Yep. So for those who remember the Dow, which was extremely popular, but its marketing exceeded its It's smart contract.
The people involved like to describe it as like a venture firm without.
Yes, it was a virtual venture fund, right?
Yeah,
and it was so popular, but then as we know, it caused the aftermath of a smart contract vulnerability caused the hard fork in Ethereum.
Yeah,
right. So by the time the DAO report came out, the DAO was no more. And so this was a teachable moment for the SEC. So they did a 21A report of investigation, basically saying, look, these promoters, Slockit, they're an issuer, right? If you sell into the US, you have to worry about US laws. If you have a platform that's trading the token, that's a security, it needs to register as an ATS or national security. All the things we're still going through now. And when it came out, though, there was the question, okay, so if a virtual venture fund, the paradigmatic example of a security, is a security, what about all these utility tokens over here? And so then we got guidance about that, and then we got guidance about this, and then we got guidance about that. So, I mean, I think more and more and more, all of the windows have closed, at least for the initial sale.
The accusation that the SEC is enforcing through action and not through clarity strikes you as disingenuous, and there's been plenty of clarity. This action is not surprised. It is inevitable. You've had plenty of opportunities to go figure out how to do it right, and this is what happens.
I think at least for the initial capital raise, yes. Yeah. And FinHub has been there. I mean, some of us have gone and spoken with FinHub for years.
Yeah.
Right. And I think, you know, and we saw with Telegram, like a lot of people remember that the
FinHub that's the SEC body for receiving questions, right?
Yes.
Okay.
Yes.
Cool.
It's like a cross-divisional office.
Okay. Cool.
And it reports Val Stepanek, who's the head of that, reports directly to Chairman Gensler.
Now, so. I want to, before we lose time, you talked a little bit about how smart contracts and what they might mean to the legal community got you involved in the first place. I think that's kind of a great way to jump off for the impact of the DAO, a venture firm without venture capitalists. That got a lot of investors involved, got a lot of investors interested. You talked about how before they were interested was kind of like a certain epoch, and now after they got interested, things changed. What are one or two things that VCs got really excited about the crypto space that changed that narrative where all of a sudden now they're investing billions of dollars?
So, I mean, I think they got excited about the numbers.
Yeah.
Right? That's what I think.
Yeah.
But I mean, right after the DAO report, what happened 2 months later? The SAFT white paper was introduced. What did that do? That allowed large investors to invest in something that they thought, although, P.S., I'll give in a second why this didn't turn out to be what they thought.
SAFT being simple agreement for future
tokens, right? Yeah. You could invest in something, and then over time, and this would be like what you invest in, this piece of paper is an explicit security. Okay, you're going to sell it pursuant to Reg D or Reg S, right? Have all the transfer restrictions, et cetera. And then over time, you're going to build out this token, this ecosystem, this blockchain. And when you deliver the token, it won't be a security, right? That was to help VCs. And we know from Telegram that doesn't work, right? One of the things the Telegram court said was, no, the delivery is not a separate transaction from the initial offer and sale. You have to look at the understandings, the contemplations, and the undertakings that took place at the time of the offer and sale. And then it's still the same transaction when you deliver it. So what does this mean practically speaking? You throw the ball up pursuant to an exemption, like Reg D or Reg S, and then you deliver it pursuant to the same one, to the same people, right? It's still a security.
And do I recall correctly that the expectation is that your technology needed to be already fully functional before you could raise the capital, or you were going to get in trouble?
I mean, essentially, yeah. I mean, for my view, not my legal view, but just my view is if you want to have a chance at saying that your token is not a security, right, then you shouldn't be selling to fundraise for it, right? You shouldn't be delivering it to people that there was a fundraising. Now, what I will say just very briefly is in the framework that the SEC put out in April 2019, there are 9 factors. Like, people hate the framework because it says almost everything is a security when it's initially issued. But there are 9 factors that talk about when something initially issued as a security may no longer be a security.
Yes.
So that is something where you could deliver, if you legally delivered your token, there is a way out. I won't get into that because that's a whole nother thing on its own. But what I would say about about VCs just in general. And we saw this with Telegram. The other point of Telegram was Telegram, as we know, couldn't deliver its grams, right? Couldn't deliver
Telegram being
US.
the messaging service.
Yes, that raised like $1 billion.
Literally $1 billion.
Yes. Yeah, and they were stopped from delivering their grams in the US and then stopped from the rest of the world. And part of the reason why was, we all sort of knew, I would say, that there was this secondary market, even though the documents say that there shouldn't be, even before the token was delivered, right? And these were not necessarily accredited. And what the Telegram court also said, aside from the SAFT point, was they looked at these people, they looked at the plan, which was supposed to be micropayments and millions of new users a month. But Telegram had sold to only a handful of purchasers, and they had $10 million as the average sale, something like that. Don't check me on that, but something like that. And so the court said, look, obviously, at least in the SEC's view, which the court agreed with, there was a plan that this was not going to land. It was not going to finish with the initial purchasers. There was a view to sell on to the public market. There was a view to get that into the hands of retail.
Yeah.
And so that made those initial purchasers underwriters. And if you have an underwriter, you don't have a good Reg D exemption.
So let's wrap things up. I want to talk about underwriters. But before we talk about underwriters, how important was this moment when VCs got into crypto? What did that, I think this is my own words, actually, the pre-VC and crypto epoch and the post-VC and crypto epoch. What's the big difference there? What did that look like in the real world?
So what I would say a couple of things. One is marketing.
Yeah.
I mean, the amount of funds that could go towards marketing is remarkable. And I think what I think as a practical matter, one of the differences is the best tech wasn't always winning as a result of the VCs. And I want to distinguish for a moment, though, between crypto native VCs, right, who really may use the tokens, who really may have portfolio companies. I mean, there are a number of crypto native VCs that have been around for a really long time. And then on the other hand, the VCs that we all know and sometimes love from the rest of the tech space and the rest of the world that then came involved.
These are the same VCs that'll say, I'm going to invest in your company, but I want you to add a token to it. And they're adding the token after the fact, not necessarily because it's a native part of what's going on there.
Go ahead.
Please, yeah.
Okay, so I think unpopular view here, but a view that I believe that the SEC has. And again, none of this is legal advice or any kind of predictive advice, really. But if you look at the VC model, it used to be you'd invest and then in an early stage company, and then you have a 10-year exit, right? And then what is the exit? Often an IPO, right? It's a registered security. Retail is the exit liquidity. There are disclosures. There are all kinds of things, so that hopefully there are risk factors and there's a process to go through, not crazy marketing, et cetera. And then what do we have now? We have a 6-month, sometimes, token exit, right? Where there's marketing. And the token often sells into retail at the highest price it has ever been and probably will ever be, may ever be, I should say. And retail doesn't know that it's the exit liquidity. It isn't a registered token, typically. There may not be those disclosures. And so you can kind of see, I don't mean to be singing Gensler's book or something like that, but you can kind of see where.
No, but I mean, it's refreshing because there is a lot of rhetoric out there. There is a lot of echo chamber talk. To wrap things up, I do think it's really interesting and important to just focus a light on there. When I asked you what was the VC's biggest impact on the industry when they got involved, your first answer was marketing. If these are securities and these VCs have been marketing them for almost a decade, what does that mean for the potential regulatory and maybe even legal fallout surrounding VCs who are investing in and promoting what may end up being deemed or maybe have already been deemed to be securities?
I mean, I think there's all kinds of interesting questions about unregistered broker-dealers. There's all kinds of other questions. But I would say my biggest concern, if I were a VC right now, is that the SEC, and actually if I were an issuer, is that the SEC would be likely to view VCs as underwriters, which means that even if you thought that you had a good Reg D exemption, If you were selling huge amounts to VCs, and by selling it, I don't just mean in the public sale. I mean back with a SAFT or some convertible note or some other structure, because I don't believe, frankly, that many of the other structures that have been throwing around change things that much, although it's case by case. But if you don't have a good exemption, then you have an illegally issued security. And so I think if the SEC, and I have a feeling that they will, if they take the view that that VCs are acting as underwriters, it calls into question the ability to use Reg D. And another thing, just people don't think about this, okay? Because sometimes people think, oh, it's just the cost of doing business. I'm going to pay a fine, if something like this happens. If there's not fraud, then maybe I don't have to worry about jail or something like that. But one thing to remember is bad actor status, okay? If you have a violation like that, you may end up being deemed to be a bad actor, and then you may not be able to raise capital using Reg D in the future, or other exemptions, or companies that you're on the board of or executive officers of. And so I think, if you're taking the long view, and I think people often don't take the long view, right? They're taking the short view. What's the cost of my doing business here? What's the regulatory cost? But there can be a long tail for that. And I think that's something really to think about, because remember, Telegram couldn't deliver in the US. It then couldn't deliver outside of the US because the SEC was saying, oh, well, the tokens are going to come back in. I think there's a reason. For a while, I had been saying, listen, you don't have to register your token. You can just sell pursuant to a valid exemption like Reg D or Reg S. Well, guess what? If the underwriter's piece comes to fruition, then what Gensler's been saying about the tokens needing to be registered makes more sense.
Josh, thank you so much for joining us. It was a pleasure to get to know you a little bit more, and of course to pick your brain as always.